Good afternoon. Before they see me, this is Chris Robinson, Managing Director of Commodities and Ags at TJM, also the publisher of the Robinson Review. Well, we're one day away from the probably one of the biggest USDA reports that we'll get during 2020. We get one every month, but typically this January report and a couple more down the road can historically give you a lot of price movement, repricing, price discovery. So tomorrow's report is big. I'm not going to get into the details of what people are expecting. I would just say this in general, the analysts out there and most producers are expecting a friendly number or a bullish number for corn, wheat, and beans. I've been doing this long enough to know that when everybody's thinking the same way, it opens up the door for some surprises. Now, obviously, if you're a producer or a farmer, you're always a long speculator, period. From the moment you get up in the morning to the time you go to bed at night, you're long all the corn, wheat, and beans. You're long all the animals you own. Plus, you're along all of the product that you're going to own or produce for the rest of your career. So you're speculating with one arm tied behind your back. So when these reports come, they give you a fixed point in time where you know you have risk. So as a risk manager, that's what we try and do. Take advantage of what the market's given us. I've got to start with soybeans. Number one, we're about 2 or 3 cents away from challenging an 8 to 9 month high. If you look at new crop soybeans, which is what hasn't even gone in the ground yet, November 2020, that's at the top of almost a 1 year high if you look back at the old prices. So to be $1 off the lows and to be at 1 year highs, it's really something that a producer needs to kind of wake up and say, oh, this is an opportunity. Now, can we go higher? Yeah. But what you don't want to be doing is a week or two or a month from now saying, oh, this was an opportunity I missed. So if you know you're always long, set a hedge to protect yourself if we drop lower. Can't really be any more clear than that. A hedge is like a seesaw. It's if your cash price goes up, you're going to lose money in your hedge, but you're going to make money in your cash price. But if you have unprotected bushels with no price floor below them with a hedge, you're opening yourself up to needless risk. So take advantage of the rally that we've had. We've had a really good rally in soybeans. We've had a very nice rally in wheat. Wheat's also challenging multi-month highs. If you look at Chicago wheat, it's $1.10 off the lows. Kansas City wheat is about $1 off the lows. Those are opportunities that you shouldn't just ignore, especially if you're a producer and you're always long. So I can't stress that enough. Take a look at protecting those commodities. Now, corn's in a different situation. It's probably, kind of sitting there waiting for the next big move. Are we going to get a weather market or a demand market? But certainly, wheat producers and soybean producers, we've had rallies worth protecting here. And if you don't think that you need to hedge or you don't understand hedging, I would offer you this suggestion. Go pull up a chart of milk, Class 2 milk. 2019 saw us, it took a whole year to rally. We had a tremendous rally. We got to a key resistance around 20, 21 bucks. That's also was a 5-year high. So a lot of people were, if you're a milk producer, that's a great development, right? You've got 5-year prices in the commodity that you produce. Well, lo and behold, it only took 1 month. 1 month and we lost half of that rally. That's why you have to hedge. You never know when the correction's going to come. So when a market gives you multi-week or multi-month or multi-year highs, you need to set a hedge. That's about it. Let's hope that the USDA gives farmers some good news and we get higher prices. In the meantime, the only way to protect yourself is to set a hedge. This is Chris Robinson. Have a great day.